70% of the people choose whoever they see first. That's the math of
Yeah,
it,
yeah.
right?
They don't want to go through the effort
There's
especially in that scenario. Like they don't want to have that
no,
conversation with five people of how they're
no.
about to lose their house.
Hi, I'm Tim Bratz, and every week I sit down with the top influential entrepreneurs in the country to discuss how to leave a true legacy in all things happiness, health, wealth, and wisdom. This is the Legacy Podcast.
Hey guys, welcome to the Legacy Podcast. I am your host, Tim Bratz. Today I'm sitting down with Nick the Note Guy, Nick Legamaro. Appreciate you being here, brother.
Thanks, buddy. How are you?
Great. So for anybody who wants to learn a little bit more about Nick, he has been in business for 25 years, had a private note creating company called Rilex Capital that they sold. When did you sell that? Probably 7, 8 years ago.
2018. Yeah. Right.
Yeah,
Just to
2018.
the bank. Yeah.
And now he's just obsessed over the data aviator business. So he works with a lot of investors, business owners across real estate, multifamily, commercial assets, private lending, any sort of B2B services, and focuses on data intelligence. And we're going to dive into exactly what that means and learn a little bit more about Nick's journey in the entrepreneurial world and how data intelligence can help us scale our businesses, raise more money, find more deals, exit more deals, all those kinds of things. So, Nick, appreciate you being here, man.
Hey, man. Thanks. Appreciate you having me on here. I'm excited to
So,
dive into this.
let's do it. So let's share a little bit about your background, right? Like, how'd you get into the entrepreneurial world? I love hearing
Yeah.
like the backstories.
Yeah. It's sort of a little bit of luck, a little bit of just, after I got out of college, I went to go work for Pepsi Cola, big, pretty, Fortune 20. I don't know what they were at the time, big company. And, went in their management trainee program and they taught me everything. And I was running my P&L was like $10 million at the age of 22. And I didn't know, anything. And then
It's wild.
I started getting into this process and I was in Phoenix at the time. And then 6 months into it, they transferred me to Texas, where I live still today, Dallas. And I was running a massive fleet operation, like 750 vehicles, 13 warehouses all throughout Texas. And I was responsible for a lot of stuff, but I really wasn't getting compensated for it. And I saw all these people that were making money. The company was making money as a result. And I go, well, I mean, I might as well try to figure out how to be a little bit more entrepreneurial because I didn't even know what the hell that word meant back when I was 22, 23 years old. And then went down the corporate road. But, then I just realized that it really wasn't the thing for me. And I was a lot further ahead of the time than people are today. Like I'd be perfect in today's world, right? It's like, I don't really care about, I think college is sort of an overrated
Yeah, we were like all the
proposition.
degenerate, right? Like 20, 25 years ago, it was like, these are just all the weirdos, right?
Exactly.
Who
Now
are
it's the cool,
unemployable. Now
now
it's
it's the
like a
cool
cool
thing.
buzzword.
Yeah, it's like you watch all these reels and the interviews from these multi-million billionaire individuals, and it's like exactly what we're talking about today. It's like you got to create your own path, and you can't be afraid of it. I love Gary V, and it's like, he just talks about this stuff. He goes, now's the time to take advantage of it when you're young, not when you're old like me. Too many
Yeah.
other responsibilities and that you have to be for, you got family and other stuff, and nothing wrong with corporate. It's just not the same as it was when I was there. That's for sure. It's and there is no more loyalty on either side of the fence for a lot of that stuff. So you need to diversify. You need to create your own opportunities. And so I tell both my kids that are in their 20s now, and it's like, look, you got to create your own. You got to create your own opportunities because no one really is going to give two rips about you more than you. Not
Hmm.
me, not your mom, not your friends, not anybody else. You got to take the bull by the horns. And if you can't figure that out, then you're going to be, you know, take the path, whatever that you have to go down.
Love it. Love it, man. So how'd you get into the real estate side of things?
Yeah, so it's funny. Um, I got started back in the early 2000s, man. I'm in literally been 25 years. And back then, you could buy properties from the bank. Bank used to sell portfolio of properties. This is way before data, right? And I had ran into an individual, and they had a lot of money, and they would go to the and I didn't have any money, and they would go to the bank and they buy a portfolio of 20, 30, 40 houses, and they chop them up. They chop up the portfolio and sell onesie, twosie at a time. And I was buying onesie, twosies, and I was fixing them and flipping them and selling them to landlords that were going to do it. And I go, okay, that's a good model, but it's not great. That's a job, not wealth building. And and then the '08 came and was a problem for a lot of people. I got out fairly unscathed, and I go, this model doesn't work. I went back into corporate. 2010, I really knew real estate was the path for most everything at that time, if you really wanted to generate and build wealth. And I said, I need to start over. And I didn't have a lot of money. I wasted a lot of money from the, not wasted, but I lost a lot of money and earning potential. And I wanted to get back into real estate. This time around 2010, data was becoming more relevant, more prevalent. Like you could get access to an internet, be able to use that instead of going and getting a foreclosure list. I used to go down in Dallas to George Roddy's office. He was one of the top foreclosure list generators. And I'd literally go back down whenever it comes out and I'd get a packet of data of like.
I remember these days, man. You download the packet and then you mark all the properties, start going through all the addresses.
And you couldn't even take it. You didn't have the ability even to take the package and scan it and do something with it. There was no spreadsheet. Anyway, that's another story. And I go, I know real estate was the path to go. So I was trying to figure out what was the way I could get into real estate that had the least amount of risk, potential upside, wasn't afraid to put in some sweat equity. And I got into the wholesaling side of it. And at that time, it wasn't this whole, throw a bunch of stuff and do direct to seller. It was all yellow letters, postcards kind of stuff, wait for the phone to ring. And one day I got a call from a lady. She was retiring from General Motors and she was moving to California to be closer to her children and grandchildren. And she had a house that she was selling and had renters in it. And back then you could buy a house for under $100,000. And this house was cheap because didn't have a lot of money. I didn't know what I was going to do. And it was like a $25,000 house. This is back in like 2000, I don't know, 9, maybe even earlier than that. Probably was a little earlier. And she goes, there's tenants in it. You can go drive by it, but I don't want you going in it. Okay. So I said, okay. So I drove by and I go, I guess that's what a $25,000 house looks like. Right. And it's like, it was a little 2-bedroom, 1 bath, maybe 700 square feet. Roof was sort of dilapidated and whatnot. I go, I don't know if I can make money on this or not. And so I drove down the street. This is literally on my first deal coming back after the fix and flip side and going into the wholesaling model. And I saw Vende Casa sign. And I know enough Spanish to be a little bit dangerous. And so I call them up and she goes, Hola. And I go, you speak English? She goes, yes. And her name was Lydia. And I go, hey, I got this house. I saw your sign. I go, would you be interested in buying, or do you know anybody it was? And she goes, what's the address? And I gave it to her. I didn't have it under contract. And she goes, how much do you want for it? I go, I want 35,000, like I knew I was talking about. And she goes, I'll call you back. So I'm literally driving from the house to where I am about a 45-minute drive. And I get a phone call. She goes, hey, I got some buyers outside the house. I go, no, they can't go knock the door. I was freaking out because it didn't really go through this process. And she goes, they're interested in the house, but they go, since they can't get inside of it, they're only going to offer you $32,000. I go, $32,000, like I'm insulted or something. I go, and how much do you want? She goes, I want $1,500. I go, let me see what I can do. Anyway, got under contract and got that deal done and made a few $1,000s on a fix and flip. Well, with that same list that I had sent out, I end up getting another couple properties in the same thing. But this time there was debt on it. Okay. There was a mortgage on it. And at the time she owed like $25,000 or $30,000. And the house was worth more like $50,000 or $60,000 at the time. And, but I didn't have $25,000 to give her to do it, to go turn around and sell it for 50. So I call Lady back.
And by the way, for folks who aren't listening, like they didn't have DSCR loans back then. No. They didn't have like this stuff didn't exist. Lending pretty much was shut down for anybody who didn't have some massive balance sheet, right? Banks were not lending on assets in the real estate world because real estate had caused the financial meltdown, and they definitely weren't giving it to like newbies, right? Like us. And so,
or to the point where I was getting to, Tim, is that they weren't also loaning to borrowers at that lower price point either, right? So sub $100,000, you couldn't even if you. It's like, dude, so there's two challenges.
I got to spin our wheels writing a loan for $30,000. It's like it's not even worth it.
And if you could qualify for a loan, you probably weren't going to go get this kind of house anyway, right? Just be
Mhm.
honest. So, long story short, she goes, "Well, I have a buyer." I go, she goes, I said, "Well, I need $40,000." I go, do you still have somebody that's got 25,000? Maybe I'll carry the balance. I go, well, if I can get my money back out of the down payment per se and give it to the seller, I'll create a note. Well, this is when my first note creating came into play. Before I even had started Riley's Capital and partnering with my partner John Montero, is I created my first note. And I didn't know what I was doing. I ended up writing like a 5% mortgage. Now we write on much higher than that. So this is what started the private mortgage note business. And what people don't realize in that you can private mortgage notes are a extremely valuable asset because the property is the collateral, not necessarily the borrower. I mean, everybody wants a nice, pretty borrower that works for Coca-Cola or General Motors or whoever that has a W-2 and lives in a. That's cool. Okay. But guess what caused the problem in 2008? Wasn't these buyers. These weren't the buyers that caused the problem. It was people that were over leveraged that did have the W-2 jobs. And that was the thing because they didn't really leverage the debt correctly by the way they collateralize it with the property. So because they over leveraged it, right? In California, you could buy a property at 125% of value. It's crazy.
It's
Can't do that
insane.
anymore. Crazy. So never was a problem in the private mortgage business, the seller carry space. And so we did thousands of these private mortgage notes and built this whole business. And in 2008, we ended up selling it to a federally chartered bank, all the assets, collateral, and had a non-compete on this. And that's sort of how I got it. I just got in it. Mitch Stevens is a good friend of mine. I reached out to him because he had been doing this for a long time. And the main challenge or main issue is that most people that are in the private mortgage note creation space, they're not professional note creators. Banks are professional note creators, right? Banks are in the banking business for a very specific reason. They're in it to control real estate, not own it. Okay. Nothing wrong with owning real estate and taking all the benefits of that. But banks, they don't own anything. They control it all. And that's sort of the mentality that I had. I go, well, if it's good enough for Bank of America and Chase and Wells Fargo, then it's probably good enough for me and good enough for most. And that was the path that we end up going down. And even to this day, I still do some creative deal structuring, hold notes in my portfolio. I personally only like holding notes that I create because I know the whole backstory versus going out and trying to traditionally buy something that somebody else did, because I know that about 84% of all private mortgage notes are created by what we call mom and pop note creators. And they don't understand compliance and underwriting and dealing with a consumer versus, you're dealing with consumers here. I mean, you got Dodd-Frank and SAFE Act and a bunch of other stuff that I don't want to get in the weeds on. But if you're ever going to create a note or buy a note, those are really important things that you really need to educate yourself on so you don't go buy a bad bill of goods, basically.
Mm-hmm. So in your business, did you guys just have your own notes, or were you educating people on how to go out and put notes out there? Like what did that look like
That's a great question.
when you were selling it?
So it was interesting. So we used to do, I did a model where I created first and second liens on the property that we created. So at the time when we would buy them. I'm just going to use round math here. Say it's a $200,000 property and we bought it, and our cost basis is 150. So we write the first lien large enough so we could leverage or sell the first lien note position to get our cash back, to get our working capital back, and then we kick the profit back in the form of basically a free and clear second note plus a little bit of cash. Because otherwise you run out of cash, because you can't, really difficult to borrow short and lend long. It doesn't really work in business, right? Well, that's exactly what you're doing when you have seller financing. If you're using it as a business, you're lending long 30-year terms, right? The returns are phenomenal, but you got to have the cash, the capital stack to be able to create that long-term debt. So if you have a lot of money, you're sitting on money, it's a great investment, secondary type of asset, not a traditional like a stock or a bond or something like that. So we just would create that and we would leverage it accordingly. And we would write note after note. And we would, instead of fixing and flipping and selling it to a retail buyer that went down to Chase to get a bank loan, we'd sell it to somebody that couldn't get qualified. Doesn't mean they were not a good borrower, just means they didn't meet the buy box. the pretty buyer that most banks require. They may not have had a W-2 job. They might have been self-employed. When you're self-employed, it's very difficult to go down and get a traditional anything. Good luck with that, especially in today's. And it was no different back then. And so we just built this whole model. We helped service the community, provided hardworking families with the opportunity of home ownership when banks basically would tell them no.
And then you took those notes and then you went and sold these notes
Yeah.
In the private market, I assume, right?
Yeah. It was pretty interesting because I had
what kind of discounts? All right. So let's say you got a house and it's a $200,000 house. You were able to buy it for, $150. You're all into it. They go in, you create two notes. One's for $150,000. The other one's for $50,000. The $150, you can go and sell that note. Are you selling it at face value or are you selling it at a discount?
So that's a great question. So before we knew what we were doing. And when we started creating this, because note buyers are looking at a couple of different things. Contrary to popular belief, the ones that are really sophisticated note buyers and understand the debt and the leverage, the borrower file is not the number one criteria. For banks, it typically is. Okay, they want to, because they have insurance they can do and a bunch of other stuff. We don't want to get to, you want to try to keep this as simple as possible. A note buyer like myself, the number one priority I'm looking at is the leverage, the investment to value, not the loan to value, the investment to value. How much am I investing to control an asset? Okay. If my borrower doesn't pay, what do I have? So when you reduce that first lien position, that note balance, and the smaller, the house is always $200,000 in this example. Let's use that. But if I can sell you a first lien note at 10% for $180,000, or I can sell you that same another first lien note that has a $150,000 value and is still secured against the same $200,000 house, which one would you rather buy?
At the same interest rate?
Same interest rate.
Well, obviously you want the lower.
Because you have
LTV.
less risk, right? Because in the event of a default, your exposure is 150 versus 180. Okay. So what would happen is that for note investors to buy it at 180, they would still buy it at 180, but the discount's going to be greater, to your point, right? How much is the discount? Because they're assessing the risk position on this. So
it's less about the return. It's more about the leverage position that they're in.
Yeah, and I learned that a long time ago. And I go, because I had a buddy of mine that was, he was selling notes back in the day. And I don't know if they still do it this way or not. There's a lot of banks that would write notes, and before the ink was even dried on thing, they had already sold that paper. Went to Wall Street, family offices. And at the time, bank rates were fairly low. They were selling stuff that had a 5% coupon at 105, 106% of value of the note value. And I'm here struggling to get 80% on a 10% interest rate. I go, why are you able to do that and I'm not? And my borrow is just as good of a borrow as yours. Well,
it's a good question.
It's a great question, and becomes because it comes down to trust, because people want to deal with certainty as much as possible. They want to deal with probability, not possibility, right? The probability that a bank underwrites the deal correctly is highly probable that they are going to cross the T's and dot the I's and underwrite the borrow and stack that collateral file the way that it's supposed to be. An individual, mom and pop, that just decided to sell it to the tenant and turn it into owner financing probably did not do all that. In fact, I already know that because we look and evaluate notes all the time, and it's like selling a car, Tim. And you sell a used car, you could have two identical Ford F-150 pickup trucks with 100,000 miles and white with tan interior. One has been meticulously taken care of with all the documentations for oil change and maintenance, and other one's been beat to crap, and then Chick-fil-A wrappers in the back, and the radio doesn't work, the windshield's cracked. Which one's worth more money?
Yeah,
right? Which one do you have more probability? Which one do you have more probability or more belief in that's going to perform for you in the future? Well, notes are no different. And that's exactly it. And that's what they were buying. Because if you're a family office or equity group, you're not looking for a 10 or 12% necessarily return. You're looking to have capital preservation, not you're not in it for the risk gain. And that's really the difference between private and the,
so how does somebody then go and underwrite something like that? Or how can they make it as bank worthy as possible.
Well, and that's exactly what we were doing. We were right. We were generating bank quality paper in a private mortgage creating. Because look, here's the bottom line: the private mortgage note business is about $30 billion a year. I mean, there's about $30 billion in new paper created every year. So that means in the last 5 to 6 years, over $150 billion. That's a pretty big number, Tim, for people, for most people that don't even understand or realize that's even a possibility. You know, they
Yeah.
might hear a seller finding, but they don't really understand what that looks like or what the implications are. It's a very challenging piece, and that's why the people that turn around and create them and then turn around and want to sell them may not get the value. Like we would never discount it at some crazy discount because we would make sure that file was correctly stacked. So it's not easy. There's people out there that teach it and educate it and will help you create a proper note structure. But there's still no guarantee on the performance, even though you do all the things correctly. You can't predict if somebody's going to, continue to pay or be on time or in the future, just like anything else. I mean, foreclosures in general are going up.
We're gonna do a case study real quick,
Yeah,
Nick.
let's do it.
All right, so I have an island that I bought that's 110 acres, and it's already parceled off into 20 single-family home lots.
Nice.
There's one house built on one of the lots, and I've just been using it for fun, right? I have some bigger opportunities available to me. I was going to do a, kind of glamping, and I had a couple different ideas for events and masterminds and all this other stuff. But the reality is I have my property management software that just got launched, and that is the highest and best use of my time right now. But I want to do something with this island, and the market's not great to sell an entire island for $7 or $8 million. It's over by Hilton Head Island in Beaufort, South Carolina, just south of Charleston. But it's already parceled off, and so I could try to sell it individual, like to one person who's going to come in and buy the whole thing. But it's already parceled in 20 different lots, and so my thought process was going to be, if I can get an average price point of $399 times 20 lots, that's $8 million. And I could take, 25% down, 100 grand down, and I'd seller finance, $300,000 on a 5-year term, interest only at some nominal interest rate, 3, 4, 5%. And somebody can come in and own a 5-acre parcel on a private island, waterfront, in an amazing location, and they have the ability to go build their own home. I'm going to give them all the specs and contacts and all that kind of stuff. Or they could set up a friggin' tent right there and hang out on their tent. But they have some time, right? So the idea was going to be, could I do this? Could I get 25% down? That 25% exceeds what my debt is on the property. Now I still have a bunch of investor equity and stuff like that, but that's a little bit more flexible. But I need the 100 grand down times 20 lots, call it. So $2 million bucks down. From that, then I can be flexible, and I could even discount these notes by 20% and sell them off for 240 grand.
Or keep them for cash flow.
Or keep them for cash flow. The only issue is I do have some investor equity involved, and they might either want to hold. I could either give it to the investors, or I could sell it off, get them cashed out, or whatever that ends up looking like. So, in that, if you were sitting down and you were advising me on this, what would you kind of say? Hey, look out for this, look out for that. I don't think anybody would be a primary home owner. It would only be for secondary homes. So I think we're kind of outside of the Dodd-Frank, I think, but I don't really know the laws.
So it could be, it could not be. Depends on if they're going to build it as a primary residence. I'm not an attorney. I'm not going to give you anything like that. But my understanding, I would. Do they need to underwrite them? It depends on how many. There's a lot of things, but let's just look at the number side of it. Okay, there's a couple different ways that you could potentially do it. Here's the problem with creating notes and selling the notes. Once you take the discount, you lose that opportunity forever, right? So if it's worth, let's just say it's worth $100,000 and you discount it for $80,000, you lost that $20,000 forever. Plus, you also lost the future revenue that you would generate from the income from the interest expense, right? Depending on whatever that looks like.
Let's assume I'm okay with that. Let's assume
Yeah.
I just want to be able to cash out, not think about it anymore.
So I would say, you could do it very similar to what we would do. And there's a couple different options. One option that I would want to look at is based on when you bought it, what your cost basis is and what it's worth. Can you sell off enough of it? How many lots did you say you have on it?
20.
20. So let's just use a round number. Could you sell 15 of them for a cash amount and be able to and keep the other 5 free and clear?
Yes.
That's whatever that math is. Maybe it's 13, maybe it's 17. Now you have you sell that up. Now your underlying debt's gone. And now you have these other parcels that are basically free and clear. Then you could take those, whatever they are, seller finance, whatever you want, because now you have infinite ROI on anything that you generate.
And I can sit on those, right?
Sit on them, do whatever you want to do them. You can hypothecate them, you can leverage them, you can do whatever you choose to do with them. Is that the best way to do it? I don't know. It depends on how patient your capital is and how much, what's your opportunity cost to do something else with it? Is it coming due? How much, how long can you tread water on this? And
I guess from my let's assume I can write it out, and we got a year or 2 years before I really need to make any serious moves on it. But the sooner I can do it, sooner I can transact on it. What do I need to be aware of when I'm writing these notes if I have the intent of selling it on the back end?
So you mean selling the notes for the cash out of them?
Correct.
Leverage
Yes.
them. Yeah, I mean, obviously, it's just the stronger the underwriting file, the better. I mean, if you are able to write the first note, or any note for that matter, relative to value, that's always going to be the number one priority, the investment. For example, if you're writing a note for $100,000 and the asset, the property, the lot is worth $200,000, the risk is, we talked about this, is good. Now, land is different.
Do most note buyers, are most of them okay with buying senior position primary loans with a secondary loan on it?
Yeah, because the first is
they don't really care. Like
no,
in commercial real estate, they do care, right?
They might,
but in residential,
here's why it's a better deal than some people might think. Who's in the second position in this situation?
it would be me.
Okay, so if they know who you are as an operator and what you do, and not just some random, cardiologist in Los Angeles, I mean, you're a real estate professional.
Yeah.
You're gonna figure out how to probably solve that problem. So, and they know.
The reality is, if their note goes sideways and they're going to foreclose on it, I'm going to be the one buying out the note again, right?
Well,
so they're
here's the bottom
in a
line.
safer position, I would think.
Here's the thing: you can't get paid unless they get paid, right? Bottom line, you cannot get paid unless they get paid, because that's the pecking order of the priority. That's the value. That's why most people don't care about a second lien. Some do, and that could just be the way that they wrote their, how they raised their capital to deploy into the whatever it is that they're looking at doing. But you have options. Now, the trick on this is going to be for you is that it's land and it's not single family residence. I mean, that's the the gold standard, if you will. A single family primary residence house is better than a undeveloped land. Doesn't mean you can't leverage it. No, absolutely you can't. It's just finding the right thing. Here's the other thing. You might be able to turn some of this back in and change the short-term debt that you have structured, for example, that you have on here, and turn it into longer-term debt and have them, participate in being the bank for that longer-term debt. When they get paid out, pay them back in the form of, maybe having been the note holder on some of the stuff. Because this is what everybody doesn't, sometimes a lot of people that are starting out in this, they have private money lenders. We all do. Most of the ones that I use, they don't want their money back. They want to get, they want to
keep it
cycling,
cycling,
invest
right?
it, because you get it back, it sits in the bank. You don't make money if it's in your wallet, right? You have to reinvest it. They might tease you a little bit with a little bit up front, but once they know that they're paying and you're getting paid on a regular basis, that changes the dynamics of this. So, there's a lot of moving parts on it at the end of the day. I mean, if it was my deal, here's my position, because I went through this pre-COVID And I could sleep very easily because when I did all this debt, because when COVID hit, we didn't know what the hell was going to happen. Let's be honest, right? They were putting a moratorium on in California on paying rent. Can you
Yep.
imagine if I wasn't a landlord? Thank God. I mean, but there's people that were landlords that weren't getting rent. They said, "Well, you don't have to pay." Well, okay. Well, do you think the bank, cares if you pay them or not? Absolutely. So I didn't really know where it's going. But what I was in the position of, because I had leveraged and sold all my first liens away. So they were gone. And all I had in my portfolio for the most part was a bunch of free and clear second lien positions with no debt on them, because that was the profit I took on the deal. So if I got into a situation where my borrowers weren't paying, I really wasn't at any risk of anything financial because I didn't have any other financial obligation. And that was really good. And now
Other
the
than
funny
lost
part,
opportunity on
yeah,
making that money from that note.
but we didn't
right?
know what was happening in COVID anyway. But the funny part about it is that never happened on anything in our portfolio. I don't know that we even had one default. We may have had some slow pays in there, but nothing was ever really of any consequence. So that was good.
This episode of the Legacy Podcast is brought to you by Smart Management Property Management Software. If you own rentals or operate a real estate business, you don't need more deals. You need more clarity. Most operators are leaving money on the table, not because the asset is bad, but because the operations are loose. Rents, expenses, payroll, maintenance, it's all spread across systems, spreadsheets, and inboxes. Smart Management brings that together in one place. It gives you real-time visibility into your cash flow and operations so you can tighten up what's already working. When you see the leaks, you fix them. And that's how you make more money on the properties you already own. No guesswork, no waiting on reports, just cleaner data and better decisions. If you want to run a tighter operation and pull more profit out of your existing portfolio, check out Smart Management. Links in the description. Now, back to the episode.
I love the private note space. It's a lot of work, but here's the thing, Tim. It's not a transactional model, right? It was when I first started, but now it's for long-term cash flow, right? So it's worth the time, energy, and effort to build this note, like you were talking about how you build it. Well, we could figure that out, but you want to do it right, and you want to spend the money and create it properly and underwrite correctly and compliance and all that, because in reality, it could be up to 25 or 30 years on a term. Okay. And that's how you got to look at it. Could it get paid off earlier? Absolutely. Can you structure it to be paid off in 5 years, 7 years? Yeah. But if you're writing a note and it's got a 30-year term on it, you want to make damn sure that you're doing it right from the beginning, because you might be having that asset for a very long time.
Mm-hmm. Mm-hmm. Dude, really good stuff. I love the note space. We've done a lot of this with, creatively exiting our properties over the course of the past few years with real estate market just getting completely kicked in the crotch. We've had to get flexible on getting our sale price by saying, hey, come and get new debt, right? Obviously the LTVs are lower and the insurance costs are higher and all these other variables that have been headwinds to the commercial real estate space. We need to still get a certain price point in order to then be able to pay back our investors, pay them the preferred returns, and have some sort of level of profit. Otherwise, we're just, to your point earlier, we're just cementing a loss or a break even or whatever today if we don't do something creative. And so one of the things that we've been doing is we'll create a seller finance note. And so we'll either come back in a secondary position or take some sort of like pref equity position, almost like a mezz loan, mezzanine debt in the LLC that's then buying the property. And we get majority of our cash back. We clear out all of our debts, get majority of the investor money back, if not all of the investor money back. And then we just hold on to the profits for the next 3 to 5 years, allow somebody else to get into a deal that they couldn't have gotten into, allow us to get out of a deal that we couldn't have gotten out of unless we did it this way. And so I think it's a really powerful tool to have in the tool belt. As a real estate investor, like you got to know how to do this stuff.
Yeah, exactly. So, I mean, and we still consult. I still consult for people, and I don't teach it anymore. I don't teach creative deal structuring. There's other people out there that are very knowledgeable when it comes to this. It's just my challenge with trying to educate, and people can go find stuff out there, and that's not a big deal. The problem with it in general is the upside gain worth the downside risk. Okay. At the end of the day, in 10, 15 years ago, absolutely. Okay. But now things are becoming a little bit more relevant. Here's the other thing that's got to be taken into consideration. You got to do on sale on some of the wraps and stuff like that. And that's cool. I'm not worried about any of that stuff, but it just makes your job more difficult at the end of the
Yeah.
day, right? That's basically it. Is just do I want to work 3 times as harder for half the return, or would I rather just go focus and do something else? And that's pretty much where we're at on this right now. If you have your own property, Tim, then you want cash flow and you don't want to be a landlord anymore. Like you're tired of being a landlord and tired of dealing with taxes and all that crap. And you have an asset. I mean, I would definitely look at an option of seller financing and creating it as a cash flowing asset versus
big time tax advantages, right? So that way you don't get hit with a huge tax bill all at once.
Yeah.
And if you're already comfortable with the asset, right? You're familiar with the property, you're familiar with the asset itself. It's just, making sure you're low enough LTV, you're getting enough down payment and papering it properly, where if the borrower doesn't perform, you can just take it back without having to go through all the rigmarole of a foreclosure if possible, or making it that much easier on you.
Yeah.
You're good with the property. Hey, I'll just take it back and I'll sell it again.
Just go repeat the process. You just go repeat the process. You just want to make sure you do it right from the beginning. Yeah.
So,
a lot of times you don't even have to go down to foreclosure. I mean, you throw a foreclosure over the fence at somebody, and then, they 95% of, at least in my portfolio, they've always cured it. They might be slow to cure or fix. Once in a blue moon, we'll do a loan modification or maybe a deed in lieu of foreclosure. Very, very rarely. I could probably count on one hand in the last 5 years actually having something go to the foreclosure steps and foreclosing.
Yeah. Nobody wants that on a credit. And in a lot of capacities, people can sell it because values have gone up so much over the past few years too.
Exactly. Cool.
Really, really good feedback and insight. So I appreciate that.
Yeah.
Let's pivot over to Data Aviator, right? You talk about your focus being on data intelligence. First off, what does that mean, right? To a layman, 3rd grade level, what is data intelligence?
Data intelligence, trying to keep it as simple as possible, is just knowing trying to predict what something's going to happen before it happens. And what I mean by that is everybody that's either a buyer or a seller on anything starts that process first in their head, thinking about it, then they take action and do something, right? And most of the time, the action they take is through online, okay? And the online is through some kind of search, watch a video, do something of that set. We want to attack the opportunity at the root level, okay, which is where the intelligence. So if I know that Tim is looking to potentially, go buy a apartment complex in, Denver, Colorado, and we know that you're starting that process, and we can see it through behavioral intent, we can be way ahead of the game before you start reaching out to an agent or local market conditions and things along those lines. It's all through, everything is public record. At the end of the day, every time somebody goes on a website, fills out a form, goes on Google, YouTube, whether you read it or not, you agree to the terms and conditions of using whatever that is. Okay. And one of the main things all those providers do is they sell data. That's just that simple. They sell the data, they sell the input. And then what we do is we buy this data, and then we start taking that digital breadcrumb, if you will, and start following it, and then building an intent profile on an individual so that we can start. It's very simple, very similar to Facebook, like how Facebook does things. You ever been on Facebook and then you look at one thing and all of a sudden you get served up all this content? Same thing. The difference between Facebook and what they do and what we're talking about doing, we're talking about real intent, because just because it's probably a bad analogy. I like dogs. Okay. So now all of a sudden I get a bunch of stuff showing up on my feed on dogs. Okay. But if I want to buy a golden doodle, okay, I'm still getting stuff served up on dogs. But if I'm searching and I have the behavioral intent around it, then, and I know that, now I can provide stuff relative to golden doodles to the audience.
Mhm.
Okay. How to buy it, where's the best place to find them? What should you be looking for? All that stuff. That's where the data intelligence comes. And you can take that same data and you can retarget with it as well. But at the end of the day, I mean, everybody, doesn't matter if it's a consumer, if it's a business, everything starts with the lead or a deal, or it has to start whether you're buying or you're selling.
That what's funny about this is I got a buddy who does similar things with data. And he said for people in the Midwest, the highest propensity for them to sell, like the one data point that they would go to was, did they subscribe to Southern Living? Right? If they subscribe to Southern Living, that means they were looking at moving somewhere south, looking at all these different cities, trying to figure out where they wanted to go. And the likelihood of them selling in the next 12 months was like sky high. It was, especially if you were in a certain age range.
That's a great example. And I think we know who the same person is. That's fine.
Yeah.
But here's what I will tell you about that. Here's where most people, because everybody needs leads to do deals, right? I mean, it doesn't matter. Everything starts with the deal. And before it even becomes a deal, it has to start with an opportunity. Because I don't care if you're in the lending business, fix and flip business, you're an agent, there has to be a deal that starts before you can even get paid on it, right? So with that said, but what a lot of people that go out and buy lists or do pay-per-click or pay-per-lead and all that stuff, that's just renting. I mean, you don't have any control over that. You don't own any of that stuff. You're assuming, just because they tell, you buy something doesn't mean, how do you know that you didn't get sold to 15 other people just like you? Happens all the time. And at the end of the day, this is just about how to get in front of it. But the main thing I want to say is that most people in real estate, not all of them, they're looking for distress signals. Okay. They're looking for people that are in distress, but I'm telling you, right, that Southern Living, that's the couple that just sent their kid out to college and they're tired of living in Iowa or Indiana or where the hell they are, and they want to go move to Florida. They're not in a distress situation. So, going buying a list of data and trying to do list stacking or something like that to find motivation. Motivation isn't always a distress signal. That's the beauty of this. But what is motivation is exactly whatever it is that you need. I need to go buy shoes. Okay. I need to go buy a new pair of running shoes. So maybe I start looking for running shoes. Well, my motivation is different for that because I need that pair of shoes. Doesn't mean I need to do it today. I don't mean I have to do it tomorrow. It just means I have some level of intent. And the data that we're talking about, we're talking like 60 billion data points here. And we're talking 270, million consumer, insights. And that's all that it is we're just looking and seeing, like, we don't care what the reason is when the data, and this can apply to anything. It could be looking for private lenders. You could be looking for houses that might need to be, that are looking to be sell. Like people are searching right now saying, how do I sell my house that I just inherited? Or how do I sell a house that has, I owe more than it's worth? Or, how do I avoid capital gains when I sell my apartment complex? I mean, those are all things that are behavioral. Those are the key things that we look for. And then from there, we build the data files from there. And then it's up to us to use it to, we sell that data, you buy that data, up to you to determine how to.
So does somebody come to you guys and say, hey, here's the problem I'm trying to solve, right? First of all, I love the name Data Aviator. I think it's a really, really great name.
Thanks. Hard to find names these days, man. Let me tell you, everybody bought it.
It is really hard. But it's deeper than just buying a list, right? This is behavioral data that you're essentially looking at, the likelihood that they're going to act in a certain capacity. So does somebody come to you with a need and say, hey, I'm raising money for my software, and it's got a heavy depreciation offering along with high upside, mitigated risk, and cash flow, and it's got checks all these different boxes. Can you find me somebody who's willing to invest in this? Right? Like
so I can find you the intent. Okay. Now, whether they're going to like you, whether they have the right, that you have the right offer for what they're looking for, they might be looking at, 3 or 4 different things. We don't know that. Okay.
Yeah.
I can identify the intent. That's what we do. Matter of fact, we build just what we build your the custom avatar for your ICP, your ideal customer profile. Okay. A customer could be a buyer or a seller, depending on what it is. Like we just did, like we have a client that does business credit. Okay. They're a big business credit provider. Well, they want to provide business credit to SMB, small, medium-sized businesses that need business credit. So guess what I found? We built a whole custom avatar for businesses that are looking for business credit. So now we have the business credit lookers and we have the business credit providers. It's up to them to do the outreach, however they want to do it, to reach out. But that applies to anything.
But
Your
this is like
roofing
the
could be
lowest
solar.
hanging fruit of anything that you could go out.
It's
and
the
find,
lowest thing.
right?
It's the beginning intentional thing. This could be 60, 90, 6 months before it even becomes a efficient. Because I can tell you, let me ask you a question. Let's talk about real estate just for a second. If somebody just loses their job, okay, and they go, oh, how am I going to sell my house? And before they're even becoming foreclosure, they're probably starting before they know they already know they're going to have a trouble making a payment, let's say, okay? They're going to know that today, okay? They're not going to assume that it's going to solve itself. They're going to probably start that process sooner than later. Whereas people that are in pre-foreclosure, and that's what people are reaching out to from a pay-per-click or a pay-per-lead or buying a list, that's way further down the road. So we want to be able to attack. It's almost sometimes harder at the beginning, but 70% of the people choose whoever they see first. That's the math of it, right?
They don't want to go through the effort of especially in that scenario. Like they don't want to have that conversation with 5 people of how they're about to lose their house.
There's a reason why when you go to buy the Chick-fil-A, they got double drive-thrus and there's 40 cars in line. There's 3 people inside. Everybody wants it sort of given to them, but they want to be able to trust, right? So when you can provide a solution and be a problem solver for somebody, and that makes a massive difference. Now, are they all going to say yes to you? Absolutely not. But at least I know there's some level of intent for whatever it is, whether it's a consumer, a business, whether it's real estate, whether it's home services, professional services. And we just build a custom avatar around, we pull the data. And here's what I'll tell you, this is the biggest challenge with the data, okay? It's timely. Most data is time sensitive, okay? And what I mean by that, people are looking for something now, and we have the algorithms and we build the scoring around how high the intent level is. If somebody's looking to sell their house fast for cash, they're probably looking to do something in the very near future. So that data set has a shelf life, right? It's not like they're thinking about it and doing it 6 months later. Other things maybe not so time sensitive, but a lot of times if they're doing something active right now, they're looking for a solution sooner, not later.
I love it, man. I love it. So how does somebody work with you guys? They say, hey, Nick, I have this issue that I'm facing, or this is something that I really want. I'm interested from a standpoint of probably 2. One is raising money for our software. 2 is and finding people that would meet that threshold. And then 2 would be users, right? And customers of our actual property management software. People who are aggravated with AppFolio and Yardi and Rent Manager and RealPage and Buildium and all these other softwares that aren't performing the way that they want them to. They have all these headwinds against them in real estate and commercial real estate and owning property. And it's like, they got all these softwares and they got nothing but bad data and they have nothing but old data, and they just can't make good operational decisions.
Great example. So right now there's people that are, there's competitors in the property management software space, right?
Mm-hmm.
And some of them are good and some of them probably are not, but it's not really a matter if the software is good or not. It's what the user thinks of it, right? There's people right now, I'll just call it ABC software. I don't need to promote anybody's name. I'm a property manager and I use ABC software and I'm so tired of it. There's people on there right now going, I'm looking for a replacement for ABC software.
Yeah, what are the best property management softwares out there? The most robust, solves the problems. Yeah.
So we take that intent search, right? And then we go take that and we do the firmographic side of it, which is who do we want to be talking to? Who do we want to find? Do we want to find property managers? Do we want to find
self-managed property owners,
whatever it is. And then we take that and we build it and we build this whole data set out with all all the verified business email addresses, LinkedIn profile data, personal information if it's available, It's a massive database. And then from there, it's scored based on, on the intent level. And so depending on what your outreach is going to be, if you're going to be calling people on the phone, you're going to want to probably have it be extremely high intent. But if you're going to be using it from an educational purpose, you want it maybe a low intent because you want to start building that trust level up by doing a blog or doing, a posting or creating videos and saying, hey, I just recorded this video on this, check this out. Because we already know who they are, right? We already know that they're a property manager. Whether they need your solution or want your solution, that's yet to be determined. So we build the custom avatar around that, and we can do it either direction. Just like we have you as our customer, we're going to build out the same profile for what it is that you need, and we just go build it. And depending on how tight and how geographically specific it is, and things like that, we just go out and build that data set out, and it's all real-time data. I guess that's the bottom line. The most important thing here, this is real time. Like when we pull and build a custom data set, we're building it for a very specific time frame. It's no less than 2 days and no more than 10. Okay, so we're not going.
So the idea is like you need some hunters going out, picking up the phones, prospecting, hammering, like being very active. You can't just put, hey, here, schedule a call or try to like run some sort of Facebook ad behind the scenes that they might see. Like this is a very specific. You need hunting strategies versus fishing strategies
for the data, for the high intent level of the data. Okay, now if it's lower intent, you can maybe build it out a little bit. So you can't, you don't want too much data because it's just going to spoil, right? It's just going to go bad. So that's why we limit this window. And typically we do a 7-day window. So whatever that data criteria search is, it's for a 7-day. We usually run them Mondays and Tuesdays for our clients. Friday, Saturday, and Sundays typically are the highest volume of searches. People are searching on the weekends and stuff. And then boom. So the next 7 days, we're running a brand new search for the last 7 days. So 7 days, then a week from now, we'll do another 7 days. And a week after that, the next batch of 7 days. And then it's just all outreach follow-up sequence. And that's the name of the game, is all in the follow-up, because this, because you do a lot of marketing. It used to be back in the day, it was like, oh, you got to have 7 touches to get somebody's attention and all that crap. Now it's like 25. It's like some crazy number. You got to keep reaching out and doing different things and having a reason to be in front of these people. We don't do any of that. Okay. We don't teach or tell you, hey, you should call these people. You should email them. You should knock on the door, bring them cookies. Don't know, don't care. That's not my level of expertise. Don't know how good your software solution is in this situation relative to other people. They might like you. They might not like you. We don't guarantee any.
Your messaging might be good, might be bad. Doesn't matter. Like it's,
but
that's up to whoever's buying the list and getting access to the list.
Yeah. So
you guys sell it the same way that like historically lists have been sold. Like, hey, let me pull the list. I pay you pay me per name, or you pay me per what?
We usually do it by it depends on who the client is and if it's geographically or nationwide. At the end of the day, you really don't want to have too much that you can't manage and do, because the data pool, we already own the data. So then it just really, if I'm processing 10,000 records or 100,000 records, it really doesn't take any more energy or effort, because I'm not at capacity. I can do, 30 million records a month. Okay. And then if I had a bunch of people that needed, and I was going to go over that, then I would probably have to throttle back or do something different. But until that's a problem, it's not a problem. So I'm not even really worried about it. So some people only get 1,000 records and some people get 100,000 records. Mm-hmm. And it just depends, because we're going to build that custom audience specifically for your needs based on what you think your client needs. So we'll take data off websites and we'll run it through our AI intelligence to say, what's the ideal customer profile for whatever this problem is that we're trying to solve. And then we'll consult back with somebody like yourself and say, does this look right? And we'll go in, and we've already built all this, and we've done it for merchant services. We've done it for business credit. We've done it for storage, people that are looking for people that are looking for storage units to buy, looking for mortgage mortgage companies that are looking for people that are looking for mortgages, and agents and things along those lines. So, real estate's a big piece of it, but I think the B2B side of it and the private money side is a massive opportunity on this. People are always researching stuff like this.
I love it, man. I love it. This has been super helpful. Nick, where can people connect with you guys in order to learn a little bit more and discover whether or not this could be a good fit for them?
Yeah, I would just say go to dataaviator.com. There's a bunch of information on there. That's sort of the high level stuff if somebody's looking to build a custom audience. And then if they look at it, we can you can book a demo or something like that if there's something that you want to build out. We'll pre-build it out, do a little questionnaire. Look, it's not this stuff's not cheap, but it's also, you don't need 10,000 records to accomplish where you usually would need 10,000 records, you might only need 200 records to accomplish the same outcome. So do you want to go through 10,000 to get to the same outcome, or would you rather just do with a fewer betters to do it that way? Most people don't have the capacity because there's a lot of changes that are happening in how you communicate, especially on the consumer side, with regulations and, auto dialers and auto texting platforms. You got to be really careful in that capacity if you're going to do, any type of consumer outreach. So we want to make sure that, we get you the least amount that you need to accomplish what you need. You can always get more. So that would just go to dataaviator.com. My contact information on it, book a call. There's some videos and stuff on there. We can help anybody out. Great. Because every business, there's not a business that I know of, and maybe you know of one, that doesn't need more business, need more clients. Doesn't matter what it is. Churches need
100%.
Churches need more people. Apartments need more tenants. Home realtors need more buyers and sellers. Everybody needs something to run a business. I don't know any business that can survive without having new customer generation. The question is, how do you generate that customer? Where does it come from? And how do you get to that potential client before your competitor does? That's really the thing. So if I know that this segment of people is going to be doing something that I potentially could benefit from, I want to know that as soon as I possibly can. It's like a house on MLS, right? Once it's on MLS, everybody knows it's for sale. How good of a deal is it then? But if you could talk to that seller before they even got an agent involved and got in there, and you can negotiate something that was beneficial for them, and you could do that and be one of the first to be able to do that, your probability of success is going to be much, much higher. And you're going to have much, more.
Yeah, at the end of the day, man, they're hotter leads and they're higher quality leads, right?
That's the bottom line.
If you have a conversion process, if you know how to convert them from being a lead into your business, this is one of the best.
Yeah, I even use the data for note buyers and note sellers too. Same thing. Need to sell my note fast for cash. How do I invest in mortgage notes? Two different sides. I can then and do that. So hope that helps out. Hope I can help some other people out. Just reach out to us, put it in the show notes, and we'll go from there.
Awesome, man. Dataaviator.com.
Yeah,
we will 100% tag it in the show notes. Nick, appreciate you being here, man. Thanks for all the insights on both the notes and the data side of things. Can't wait to see you at the next mastermind event.
All right, buddy. Have a good one. Be safe. Take care.
All right. Thank you, guys. We'll see you next week on the Legacy Podcast.